Hi everyone, Claire here, and welcome back to Pit News On Air. In this episode, our podcast team is diving into one of the most talked about articles from this month's issue of Pit News magazine, Unmasking the BlackRock Algorithm, a retail trader's conspiracy theory, by veteran trader Lan Turner. It's a bold, behind-the-curtain look at how the world's most powerful algorithm, BlackRock's Aladdin, might not just be managing money but quietly shaping market behavior. Can retail traders really reverse engineer the rhythm of an institutional-level algo? Let's find out.
Ever get that feeling when you're looking at the markets? Like, you're always just a step behind, reacting, not acting.
Yeah, like someone or something already knows the playbook. It's a common feeling, I think.
Totally. Well, today we're going to dig into a theory that might just shed some light on that exact feeling.
We're looking at an article from Pit News magazine, right? By Lan Turner. He's a longtime trader, 35 years, now editor-in-chief there.
Exactly. And our mission here, for everyone listening, is to really get under the skin of his perspective. He's got this theory about algorithmic trading, specifically BlackRock's huge Aladdin platform.
The $10 trillion one.
Yeah, that one. And how it might be, subtly shaping how the market moves, how it breathes. We want to explore his observations on patterns, emotion, news, the whole picture.
And Turner's coming at this from decades of experience. His article, The BlackRock Algorithm, My Conspiracy Theory, really leans on that. He talks about learning the classic stuff early on. Week-off accumulation, distribution, Fibonacci levels, Elliott wave, the whole fear and greed cycle, tools he's used forever.
And you brought this article to our attention, so clearly these kinds of underlying forces are something you've been thinking about too. Let's jump into his main idea then. He's watching these patterns for decades.
Right, applying these classic methods.
But something starts to feel off.
Yeah, that's the sense you get. He says the patterns started to seem less like natural market ebb and flow and more. Well, his word is orchestrated.
Orchestrated, that's a strong word.
It is, implying a kind of direction, a precision that felt maybe unnatural, less random than you'd expect.
And the name that pops up is BlackRock. Specifically Aladdin, this, enormous system. We said $10 trillion under management through it.
Around that, yeah. It's massive. And Turner's careful, he calls it his theory, his hypothesis, because obviously the actual code, the inner workings, that's a black box.
Right, proprietary stuff.
But given his experience, he starts to wonder if Aladdin is doing more than just managing portfolios for clients.
He thinks it might be, what? Setting the rhythm of the market somehow.
That's the implication, that it could be subtly controlling the tempo, the sentiment, maybe even sending, well, he speculates, sending messages.
Messages to who?
He throws out examples like potentially the Fed, the White House, maybe even figures like Elon Musk, as mentioned in the piece. It's speculative, of course.
Wow, okay, that's a big leap from portfolio management.
It is. But think about the scale. $10 trillion. If BlackRock, maybe via Aladdin, decides a certain rally is getting ahead of itself, could its sheer weight dampen that?
You'd think it could have some impact, yeah.
Conversely, could it initiate moves, help push things in a certain direction if it aligns with their analysis or positioning? It's plausible at that scale.
And it definitely taps into that retail trader frustration, doesn't it? That feeling of constantly being on the wrong side of the big swings.
Absolutely, which brings us neatly to the fear and greed cycle, a classic concept.
Right, the emotional roller coaster. Talk us through that quickly.
Sure. It starts with optimism, maybe after a crash. That builds into excitement. Then euphoria as prices peak. Everyone feels like a genius.
The cup?
Then anxiety sets in as things wobble. Denial, just a dip. Then fear, panic, despair, and finally capitulation. That's when many retail folks throw in the towel, often near the bottom.
And that's when the smart money supposedly steps in.
Traditionally, yes. But Turner's angle is interesting. He suggests Aladdin isn't just reacting to this cycle, exploiting it.
But it's causing it. Or amplifying it.
Potentially. Maybe amplifying it. An algorithm doesn't feel fear or greed, obviously, but it's designed to spot patterns. Patterns in volume, price actions, sentiment indicators. Basically, the digital footprints of human emotion.
So it reads the room, digitally speaking.
You could say that. And the theory is it's programmed to see these emotional extremes developing in the crowd.
And take the other side of the trade.
That seems to be Turner's core hypothesis. It positions itself against the herd's emotional impulses.
Which links straight into this pyramid problem he describes. Explain that.
Okay, so he sees many retail traders building what he calls an upside-down pyramid. They buy a bit, Price goes up, they buy more. Price goes higher, they buy even more.
Dollar cost averaging, but upwards into strength.
Exactly. They're increasing their exposure, their risk. The higher the market goes, their average cost keeps rising.
Makes sense. But why is it a problem?
Because their biggest positions are often near the market top, so even a small pullback starts hurting them disproportionately. They're most vulnerable right when the risk of a reversal is highest.
Ah, I see. So what's the alternative? The smart money approach.
Turner calls it the upright pyramid. This is what he believes Aladdin and pros tend to do. They accumulate, they buy when prices are weak or going sideways.
Buying into fear, not euphoria. Dollar cost averaging down.
Precisely. Building a solid base when nobody else wants it. So while retail might be panicking and selling near the bottom,
Aladdin is quietly buying.
that's the theory. It absorbs that selling pressure. Then, maybe when conditions are right, perhaps helped along, Turner might argue the market turns. Volume picks up. Things look positive again.
And retail jumps back in, chasing the rally.
Often, yes. But the smart money, having bought low, they're now potentially selling into that retail buying strength.
Unwinding their positions as the crowd gets excited.
Exactly. Taking profits off the table as the upside-down pyramid builders are getting fully invested near the new highs.
Okay, that paints a picture. So the big question then, can the little guy, the retail trader, even compete in this environment?
Turner's pretty realistic about it. He says, look, you're probably not going to outcalculate or outspeed Aladdin directly. That's likely a losing game.
Doesn't sound too hopeful.
Well, he doesn't leave it there. His proposed solution is interesting. It's about reverse engineering the behavior.
Reverse engineering, how?
By going back to those classic techniques he learned, week-off analysis, for instance.
Remind me about wake-off. Accumulation and distribution.
Yeah. It's about reading the chart for signs of quiet buying by big players that's accumulation. Often happens during boring sideways markets with low volume. They're soaking up shares without pushing the price up too much.
Like building that base.
Exactly. And distribution is the opposite, selling off shares into rising prices. Or at the top, again, trying not to cause a panic initially, more sideways action, maybe churning.
Okay, so look for those quiet periods. What else?
Fibonacci retracements. Think of them as potential support and resistance levels based on mathematical ratios found in nature.
Right. The 38.2%, 50%, 61.8% levels people draw on charts.
Those are the main ones. Turner talks about a delta cone of probability where multiple fib levels might cluster, suggesting a higher chance of the price bouncing or reversing there.
An Elliott wave. That always seemed complicated.
It can be, yeah. But the basic idea is that markets move in predictable wave patterns, impulses in the direction of the main trend, corrections against it. It helps frame the bigger picture, potentially.
So use these old school tools to try and spot what the big money, maybe Aladdin, is doing.
That's part of it. But crucially, Turner emphasizes understanding your own emotions. That fear and greed cycle isn't just something the market does. It's something you feel.
Ah, so self-awareness is key.
Hugely key. He suggests that intense anxiety during a sell-off, that might actually be a signal that smart money is starting to buy, and that feeling of pure euphoria that you can't lose.
Danger sign. Potential top.
Could be a trap, yeah. A sign that distribution might be happening, so act counter to your gut feeling sometimes.
Okay, let's shift gears slightly. What about news? We're always told news drives the market. What's Turner's take?
This is another really thought-provoking part of his theory. He basically suggests that news and fundamental events often aren't the primary driver.
Seriously? Then what are they?
More like a cover story or a catalyst. He argues the algorithm might have already decided on a move or speeded it based on its internal logic and pattern recognition.
And the news just provides a convenient explanation afterwards.
That's the idea. The market sells off sharply, then some negative news headline pops up that seems to explain it. But maybe the selling started first, algorithmically. Chicken and egg, you know?
So the move precedes the narrative, sometimes.
Frequently, in his view.
Right.
And the mainstream financial media, they play a role, maybe unintentionally.
How so?
Well, they report the news, the data, the analysis. But where does a lot of that analysis and data come from? Often from the big players themselves, like BlackRock.
Ah, so the information flow can reinforce the moves.
It can create a feedback loop, potentially. Not necessarily deliberate manipulation by the media, just the nature of how information gets disseminated. And think about it. How often does news predict the next big move versus explaining the last one?
Usually it's explaining what just happened, yeah.
So picture this. Market drops, news gives a reason, panic selling increases. While perhaps Aladdin is using that dip, that news cover, to quietly accumulate.
That's quite a different way of looking at things.
Yeah.
Which brings us back to the question he asked himself, is it a conspiracy?
And he's clear, again, he calls it his theory. He doesn't have the code, the proof. He frames BlackRock not as some cartoon villain,
Right.
but as playing like 4D chess, a highly sophisticated game using the tools and capital available within the market's rules.
And he argues the underlying principles are still valid, Wyckoff, fear, greed, etc.
Absolutely. He believes those cycles, the accumulation distribution phases, they're still happening. It's just that algorithms might be influencing the timing and intensity. He even talks about seeing algorithmic fingerprints on the charts if you know how to read them using these classic methods.
And it's not just BlackRock in isolation, is it? There's the bigger picture.
Right. He mentions the big three, BlackRock, Vanguard, State Street. Their collective size is staggering. They own significant chunks of almost everything. Their actions, even just standard portfolio adjustments, inevitably ripple through the market.
So their sheer scale matters, regardless of intent.
Definitely. But then there's another layer, Turner points out. BlackRock licenses Aladdin to other major financial institutions, dozens, maybe hundreds of them.
Whoa. So other big players are using the same core system.
Or at least a system with a similar underlying logic, potentially derived from Aladdin. He speculates this could create a kind of hive mind.
A network effect. Institutions using similar tools, potentially reacting in similar ways, amplifying trends.
That's the potential implication. Not necessarily coordination, but convergence of behavior driven by similar algorithmic logic.
Okay, so let's try and distill this. For listeners feeling perpetually wrong-footed in the market, Turner's theory offers a possible reason why, right? The potential influence of one massive algorithm, or maybe this network effect.
It provides a framework for that feeling, yeah. A potential explanation beyond just markets are random or I'm bad at this.
But crucially, it's not meant to be disempowering.
No, quite the opposite, I think. Turner's message seems to be, understand the game being played. Don't try to beat the machine at its own game, but understand the behavior it targets.
So the advice boils down to learn the foundations. Wyckoff, Fibonacci, Elliott wave, and especially that fear and greed cycle in yourself and others.
Yes. And understand how news narratives can function. Stop chasing price for its own sake. Focus on behavior, on accumulation, on distribution.
Basically, try to trade like Aladdin. Or at least trade like the smart money is supposed to trade.
Buy low, sell high. Buy fear, sell greed. It sounds simple, but it's incredibly hard emotionally. That's the core challenge.
And he leaves us with that final gut check, doesn't he?
Yeah, that's a great takeaway. Next time the market's screaming higher, 52-week highs, everyone's euphoric, your gut says buy, don't miss out.
Pause
and ask, what would Aladdin likely be doing right now? Is it buying alongside me, or is it maybe selling to me?
A very sobering question.
Yeah.
So wrapping up, Turner's theory highlights Aladdin's potential sway, how it might exploit retail patterns, and suggests using classic analysis and emotional discipline to navigate.
Yeah, and by grappling with these ideas, hopefully you, the listener, can look at market commentary, news, and your own trading decisions with a more critical, maybe more informed eye. Question the surface narrative.
Definitely gives you food for thought next time you look at a chart or read a headline. Really consider what might be happening beneath the surface. And maybe, if folks are interested, we could dive deeper into Wyckoff or Fibonacci's another time.
Could be interesting, yeah. There's a lot there.
Great. Well, thanks for joining us for this deep dive.
Thanks for having me.
Hi again, it's me, Claire. Well, that's it for today's episode. Thanks again for listening to Pitt News on Air. Before we go, I want to leave you with a quick tip. If you're ready to take your trading to the next level, check out the Track and Trade live trading platform. It's the same software Mr. Turner uses to design, test, and run his own BlackRock Aladdin-style trading algorithms. No programming required. Whether you're trading stocks with drag-and-drop order tools or diving into futures, with no pattern day trading rules. Start your trading account with as little as $5,000 and trade to your heart's content. Track and Trade makes trading fast, visual, and intuitive. You can see it in action online at trackandtrade.com. That's TRACK, the letter N, trade.com. We'll see you in the next episode. And as always, thanks for trading with us.